The following video is about the coronavirus pandemic that we are currently living through. However, we will not start our story in 2020. Instead, we will begin in 1987. This was when a young boy, exactly my age, 18, was matriculating from Kearney College in KwaZulu-Natal. His dad was 46 at the time and had driven down from Joburg to collect him after one of the most volatile weeks in the Johannesburg Stock Exchange. That week had experienced the biggest stock market crash since 1929, and it affected all areas of the world. As a fresh-faced matric, the boy had no idea what had just happened, and neither could he emphasize with his father, who had just had one of the worst weeks of his life. The boy knows now what caused the crash of 1987, but always wished he'd known at school. He has seen elements of 1987 in today's coronavirus crash, and calls it a financial meltdown of the magnitude that will, most likely, never be witnessed in our lifetimes again. He believes it will create opportunities for the intelligent investor, which may never be repeated. But intelligent investors don't just have to be business analysts and stockbrokers, they can also be schoolboys. The boy's name is Anton Apps, and he is now the chief lecturer at the St. Andrews College Entrepreneurs Club. In this video series, we'll make use of the opportunity that he never had, which is learning how to invest in this volatile bear market we find ourselves in. But first, we need to understand our situation. This brings us to the first question of this video series. What just happened? Here is our first example of the crash. This graph shows the Dow Jones Industrial Average on the 18th of March 2020. Referred to as the Dow Jones, or simply the Dow, it is a stock market index that measures the stock performance of 30 large companies listed on stock exchanges in the US. These include the likes of Apple, Boeing, Coca-Cola, and Goldman Sachs, blue chip companies that should be making investors steady returns. The graph shows the Dow over a 6-month period, where all you can really see is red. Notice how the graph drops off quickly after March, a time when the coronavirus was prevalent in the States and had just entered South Africa. Also look at the open and low for the day, coming onto your screen now. Minusing the low from the open price, we can see an incredible loss of over $2,000, a massive amount considering the day's trading hadn't even closed yet. What's even more incredible is that this wasn't even one of the biggest drops of the month, with the biggest coming in late February. This all amounts to the Dow experiencing huge losses before the month of March was out, dropping from 29,000 points to 21,000 points in a 3-week period. This all equates into a loss of roughly 30% of the Dow's total value. Here are two other examples, called the S&P 500 and the Nasdaq indices. Standard & Poor's measures the top 500 performing companies in the States, while Nasdaq measures the top performing tech companies in the States. Both indices are very similar to the Dow, and made very similar losses during the month of March. These losses show the fear that the States has for the coronavirus, with investors quickly pulling their money out of their options in order to become more liquid and prevent further losses. But what was investment looking like across the pond in the UK? Here is the Financial Times Stock Exchange 100 Index, taken on March 16, 2020, 2 days before our Dow Jones graph. This index shows the performance of the top 100 listed companies in the UK, including BP, Unilever, and Vodafone Group. Although a loss of 6.14% in a day in a graph that has a gradient shooting straight down into the floor is enough to make anyone scared, look even closer. Did you see it? If not, here's a hint. The graph shows the FTSE 100 losing 329 points, over 6%, in the space of 10 minutes, something which has never been seen before on this index. More than 6/100ths of its value had been lost in the first 15 minutes after trading, exposing the volatility that the UK markets had felt as a result of the COVID-19 pandemic. Two other UK-based indices are the FTSE 250 index and the FTSE All-Share index. The first one consists of the 101st and 350th largest companies listed on the London Stock Exchange. The second, formerly known as the FTSE Actuaries All-Share Index, comprises of around 600 of more than 2,000 of the companies traded on the London Stock Exchange. Again, like the FTSE 100, they are very similar indices and made similar losses during the month of March. Like in the US, the fear of the coronavirus had taken its hold over the UK, and these staggering losses showed that perfectly. This isn't just taking place in the US or UK though, it's taking place all over the world. This table includes indices from all around the world, some of which we've already covered, but others which include the Nikkei 225 from Japan, the DAX from Germany, the IBEX from Spain, and the ASX from Australia. As the virus spread to these countries, so did the fear of market volatility that came with it, which meant lots of countries saw a big loss during the month of March. Along with the drop of indices, there came a drop with other assets like bonds and property. Oil prices plummeted during the month of March, as did many other commodities. All in all, the global economy experienced huge losses in global markets in a very short period of time. Indices, which show the average performance of the companies which they are made up of, experienced huge losses during this time, meaning the majority of companies were not performing well. Lastly, investors predicted an even more volatile market after the month of March, causing an already depleted global market to become a worldwide crisis. Part 2 of this video series will be posted on the channel soon, so until then, like, subscribe, and support the St Andrews College Entrepreneurs Club.